independent judgments. With that, let's hear from Richard.
Thanks, Laura, and good afternoon, everyone. Against a largely unchanged economic and fiscal backdrop since our last forecast in March, this budget delivers one of the largest increases in spending, tax and borrowing of any fiscal event in history. In the 14 years since the OBR was established, it was only George Osborne's first budget after the 2010 general election and Rishi Sunak's mid-pandemic economic update in July of 2020 that rivaled this budget in terms of the overall change in the stance of fiscal policy. I'll first take you through how the budget spending and tax policies reshape the public finances in the next 5 years. I'll then talk about their impact on the demand and supply side of the economy. And I'll then conclude with what it all means for the government's prospects of meeting its new fiscal targets and the risks around them. But let me start with public spending, which is the biggest moving part in this budget. Relative to the plan set by the previous government, this Chancellor's added around £70 billion per year to public spending over the next 5 years. As a result, the size of the state settles at 44% of GDP by the end of the decade. This is around 5 percentage points higher than it was before the pandemic, and around 2 percentage points higher than the level implied by the previous government spending plans. This increase in spending reflects both the funding of some undisclosed spending pressures, which existed at the time of the March budget and have subsequently come to light, and the cost of new policy decisions taken by this government. Looking at the composition of this increase in spending, about 2/3 goes on current spending, which raises its annual real growth over the forecast period from 1 to 1.5% per year. The other third goes on capital spending and keeps public investment broadly flat at around 2.5% of GDP over the next 5 years, rather than dropping to the 1.7% assumed in the previous government's plans. Some of the increase in spending in the early years includes additional payments for the infected blood and Post Office Horizon compensation schemes. But most of the increase over the 5 years is added to departmental expenditure plans, which were set by the previous government, with departmental current spending £23 billion higher in this year and £49 billion higher by 2028-29. And departmental capital spending largely unchanged this year, but £24 billion higher by 2028-29. The budget also provides more detail about the breakdown of the spending between departments. After topping up day-to-day departmental spending in this financial year by £23 billion and setting new departmental expenditure limits, or DELs, for 2025-26. As you can see from this chart of real growth and resource DEL budgets over the next 2 years, most major departments now see significant real growth in their budgets this year. But growth slows significantly going into next year, with growth in NHS spending falling from 4.7% this year to 3.3% next year, and defence spending slowing from over 3% this year to almost no real growth next year. And some departments, including the Home Office, experience significant real cuts in spending in both years. We'll need to wait for the full multi-year spending review next year to understand what the budget means for the composition of departmental spending over the remainder of the Parliament. In the meantime, this chart compares the growth in the overall resource DEL envelope that the government set for this exercise, which rises by about 1.3% per year in real terms from 2026-27 onwards, with the additional expenditure required to meet the long-term spending commitments that this government's already made in areas like health, defence and overseas aid. Subtracting these existing commitments from the overall envelope leaves real DEL spending on all the departments falling by 1.1% in real terms in the 4 final years of the forecast. And this assumes the government makes no progress over the next 5 years towards its aspirations for raising defence spending to 2.5% of GDP or returning overseas aid to 0.7%. Meeting these aspirations would mean unprotected departments see their budgets fall by 3.5% in real terms in the years beyond 2025-26. Turning to how this additional spending is funded, just over half is paid for by an increase in taxes, which raises about £3.6 billion a year in extra revenue over the next 5 years. Most of that increase in taxes comes from an increase in employer national insurance contributions, which raises about £800 per year per employee and £24 billion in total. Another £6 billion comes from an increase in capital gains tax, inheritance tax, and other taxes on assets. Another £4 billion comes from various HMRC compliance measures. And the remaining £2 billion comes from a range of smaller measures, including the levying of VAT on private schools. Together, these measures increase the overall tax take to 38% of GDP by the end of the decade, its highest level on record, and 5 percentage points higher than before the pandemic. While the NICS rise is collected from the employer, we assume that around 3/4 of the cost is eventually passed on to employees through lower real wages, with employers paying the remaining quarter via lower profits. The remaining half of the increase in spending is funded through higher government borrowing in each year of the forecast. This chart decomposes the change in the level of borrowing compared to our March forecast into the relatively small changes in our pre-measures forecast, shown in green. These add £21 billion to borrowing this year, mostly due to higher debt interest costs, and reduce borrowing by small amounts in the years thereafter. The Chancellor's decision in this budget to raise the level of current and capital spending, shown in shades of blue, adds £47 and £25 billion respectively in the final year of the forecast. The tax rises in this budget, shown in yellow, raise about £42 billion by 2029-30. And taken together, these budget measures and their indirect effects on the economy leave the level of borrowing, shown in black diamonds, around £28 billion a year higher over the next 5 years. Turning to the implications of these changes for the path of total government borrowing as a share of the economy, the net fiscal loosening in this budget slows the pace of fiscal consolidation relative to the plans of the previous government. Borrowing is now flat at 4.5% of GDP this year, and then falls back gradually to 2.1% of GDP by the final year of the forecast. Compared with our March forecast, borrowing is now on average about 1% of GDP higher in every year. The budget also shifts the composition of the fiscal consolidation away from current spending as a share of GDP, which accounted for 2/3 of the previous government's deficit reduction plan, towards increases in taxes, which account for 2/3 of this government's plans for reducing the deficit over the next 5 years. The additional £180 billion in borrowing over the forecast means that net debt ends up around 3% of GDP higher than in March, and stays broadly flat as a share of the economy in the coming years. Net debt excluding the Bank of England, the previous government's fiscal target, now rises as a share of GDP in every year, from 89% last year to 96% by the end of the decade. And the interest costs on this debt are also higher, and are now forecast to exceed £100 billion in each of the next 5 years. Turning to what impact this fiscal loosening has on our economy forecast, this chart splits the impact of fiscal policy changes in this budget into their impacts on the demand side of the economy, shown in blue, and their impacts on the supply side of the economy, shown in other colours. As you can see from the blue bars, the net fiscal loosening provides a temporary boost to demand, which raises the level of GDP by slightly over 0.5% at its peak impact next year. The impact then tapers to zero, as monetary policy and associated changes in wages and prices are assumed to crowd out some private spending and bring GDP back into line with potential output by the end of our forecast. The policies in this budget also have lasting impacts, both positive and negative, on the supply side of the economy over the 5-year forecast period. Starting from the green bars, the increase in public investment in this budget boosts the level of potential output by a bit more than 0.1%. Weighing against this is the increase in employer NICS, shown in yellow, which we assume reduces employment by around 50,000 and potential output by around 0.1%. And finally, the increase in the public sector's use of resources in an economy close to its potential level of output leads to the crowding out of some business investment, shown in the purple bars, reducing output by around 0.2%. As you can see from the black diamonds on this chart, the net effect of all these changes is to leave the level of GDP higher in the near term, but broadly unchanged in the medium term. However, were the government to sustain the high level of investment assumed in this forecast in the period beyond our 5-year horizon, then the net effect of government policy would turn positive in the early 2030s, as the lagged impact of a larger public capital stock feeds through to potential output. Looking at the path of GDP relative to our March forecast, we expect the economy to grow faster in the near term at 1.1% this year and 2% in 2025, supported by stronger outturn data and the net fiscal stimulus in this budget, which, as you can see from this chart on the right, pushes GDP up by about 0.5% above its potential level. But growth falls back in the final 3 years of the forecast to around 1.5%, slightly below its estimated potential rate as the positive output gap closes. Inflation is also higher in the near term than we forecast in March, rising to a quarterly peak of 2.7% in the middle of next year. Higher inflation reflects a combination of more persistent growth in nominal earnings, the inflationary impact of the fiscal loosening, the rise in employer costs from the NICS measure being passed on to prices, and the net impact of several other budget tax changes on the prices of specific consumer goods and services. Inflation then gradually returns back to its 2% target by the forecast horizon as these effects fade and the positive output gap closes. Bank rate expectations are also about half a percentage point higher in the near term and a quarter percentage point higher in the medium term than in our March forecast. This reflects higher market expectations for bank rate at the time we closed our pre-measures forecast in September and the fiscal loosening in this budget, not all of which would have been anticipated at the time. Let me conclude with what this forecast means for the government's new fiscal rules and performance against them. Alongside this budget, the Chancellor's announced two new fiscal rules. The first one is for the current budget, or the difference between day-to-day spending and revenue, to be in surplus. The second is to get net financial liabilities, or the difference between its financial liabilities and financial assets, falling as a share of GDP. Both targets currently fall due in 2029-30. The first of these rules is familiar to seasoned fiscal policy watchers and is featured in 6 of the 10 fiscal frameworks the UK has had since 1997. The second is an innovation in the UK and a relative novelty internationally. As we describe in an annex to the EFO, public sector net liabilities, known as PSNUFL, includes a wider range of liabilities and assets beyond just the debt and liquid financial assets captured in the previous net debt measure. The additional financial liabilities are primarily those of funded public sector pension schemes, and the financial assets include loans and equities issued or purchased by public bodies. Targeting PSNUFL enables the government to borrow to invest in these financial instruments without changing the level or trajectory of the measure, something that was not true of the old debt target, which just recognized the borrowing. However, it's important to stress that physical assets remain outside the measure, meaning that borrowing to invest directly in things like roads, railways, schools, and hospitals will still push the level of PSNUFL upwards. As you can see from the chart on the left, this budget leaves the government on course to meet its first fiscal rule 2 years early, in 2027-28. This leaves the Chancellor £10 billion worth of headroom against a target to balance the current budget by 2029-30. As you can see from the chart on the right, the government's also on course to get net financial liabilities falling 2 years early, and this leaves the Chancellor with £16 billion of headroom against this measure in the target year. However, had the Chancellor retained her predecessor's main fiscal rule of getting debt excluding the Bank of England falling in the 5th year of the forecast, she would have missed this by around £6 billion. But even the £10 billion in headroom the Chancellor retains against her new fiscal rules is small by historical standards. As this chart shows, it's around a third of the £28 billion average headroom that previous Chancellors have held against their rules, and she's chosen to make things harder for herself by allowing the target to roll toward her for the next 2 years until it becomes the 3rd year of the forecast. But against any measure and over any horizon, the level of headroom the Chancellor has set aside against her fiscal rules remains a small fraction of the risks around the economic and fiscal outlook. The budget crystallizes a number of significant fiscal policy risks, which we've highlighted over successive forecasts, including by making explicit provision for the compensation of the victims of the infected blood and Post Office Horizon inquiries at a total cost of £14 billion over the forecast. The budget also ends the practice of pre-committing a large share of the Treasury's resource DEL reserve well before the start of the fiscal year. And it fills in some of the details around the composition of departmental spending next year, and adds significant sums to the envelope for forthcoming spending review exercises covering the remainder of the Parliament. But against this, the Chancellor's budget also continues to incorporate a number of policy assumptions that few of her predecessors ever implemented, including the indexation of fuel duty, which, if not delivered, would reduce a headroom by nearly £5 billion. It also makes no evident progress toward meeting the government's stated ambitions of raising defence spending to 2.5% of GDP, or overseas aid to 0.7% of GNI, which would cost a combined £24 billion. This sets the government up for a challenging spending review next year, given the overall envelope for departmental spending is set to fall as a share of GDP from 2026-27 onwards. And the Chancellor's new fiscal rule targeting the financial balance sheet creates strong incentives to move public investment into financial vehicles such as loans and equity injections, which, if not carefully monitored, could create risks in future. And all these fiscal policy risks are a fraction of the risk to the economic outlook. In the final year of our forecast, the headroom against the government's fiscal targets will be wiped out by a 0.3 percentage point rise in interest rates, a 1.1 percentage point rise in RPI inflation, or just 0.7 percentage points off the rate of economic growth in the final year of our forecast. In summary, The Chancellor's first budget delivers a large sustained increase in spending, tax and borrowing. It increases spending by 2% of GDP by the end of the decade, in an attempt to prevent real cuts in some departments' current budgets and stop public investment from falling as a share of GDP. Just over half of this is funded by a 1% of GDP increase in taxes on employment and assets, and from a raft of compliance measures. The other half is funded by increasing borrowing by around 1% of GDP in each of the next 5 years, which slows the pace of fiscal consolidation relative to the previous government's plans. The net fiscal loosening delivers a temporary boost to GDP, with growth reaching 2% in 2025, but leaves a level of output broadly unchanged at our 5-year forecast horizon. To make room for this extra borrowing, the government's announced new fiscal rules, but maintain the practice of setting aside very small margins against them. And the potential claims in those margins are numerous, with interest rates on government debt, government's large and rising debt remaining highly volatile, the steady rise in the tax burden over the next 5 years relying on a range of uncertain tax changes, and a multi-year departmental spending review not set to conclude until sometime next year. And with that, I'll hand it back to Laura, who'll take your questions.
Thank you, Richard. So as a reminder, if you're joining us online, you can submit questions via Slido. The link's on our website. We've got plenty of time for questions, which is just as well, because we have an awful lot to get through. I am going to reward those here in the room not quite first this time, because there's a lot of questions online on one topic, which would be probably prudent to tackle first, and it's related to black holes, a key term in fiscal analysis these days. So today, alongside the EFO, we've published a review of the March 2020 forecast for departmental expenditure limits. I'm going to come to you on this, Richard. Various questions. One says, Labour says that there is a 22 billion black hole in government budgets, according to the OBR. Rishi Sunak has just said that the OBR report doesn't mention this. Does the OBR recognise the 22 billion black hole in their analysis or not?
After the Chancellor made her statement in July, we initiated a review into the preparation of the March 2024 budget and to look into the preparation of that budget. What that review uncovered, and the report of which is published today, is that at the time we were preparing the March budget, the Treasury had information about £9.5 billion worth of net pressure on departments' budgets in 2024-25, which it did not share with us. And what the review says is that had we had this information and had it been available to us at the time, we would have reached a materially different judgment about resource DEL spending in the current financial year. What we cannot say is how much higher our forecast for departmental spending in 2024-25 would have been, as we can't recreate the further conversations we would have had if that additional information had been provided to us. But what we can say is that at the time we produced that budget back in March, we'd assumed a £2.9 billion underspend against departments' budgets in our March forecast. That would very likely have been dropped. And so our forecast for spending this year would have been materially higher than what was in our March forecast for DEL in the March EFO. In this government's budget, they've added around £23 billion to departmental expenditure limits in this financial year. But this reflects a combination of the government's decisions to fund some of those pressures, as well as new policies announced by this government since March. And it is impossible to say what a different government or chancellor would have done in other circumstances. So the bottom line is that we conducted a review which discovered £9.5 billion worth of pressures on budgets. What we can't say is to what extent those pressures would have been accommodated by a previous government, but certainly had we known about them at the time, we would have had a different forecast for departmental spending in 2024-25, and it would have been materially higher.
And I have one follow-up on this topic, and then I'll come to the room, which is how can you ensure something like this doesn't happen again?
So as part of the review, and the purpose of the review was to identify what weaknesses there were in the process for preparing our departmental forecasts and making recommendations for how to improve them going forward. The review has 10 recommendations, all of which were accepted by the Treasury and which were implemented in the preparation of this forecast, which are around improving information sharing, improving transparency, and improving the content of our EFO document when it comes to departmental spending, both about the identification of pressures, the confirmation of changes to departmental budgets, as well as the risks around those budgets. And I think you'll see in the EFO document this time around, there's a lot more information on DEL, and the Treasury has also shared with us a lot more information about DEL in this forecast.
Thank you, Richard. Right, questions from the room. We'll come to the front first.
Thanks. so much. My name's Aaron Olsen from The Telegraph. I was just wondering if you could talk us through the decision to publish the review today. Was there a rule determining it had to be published today? If not, why today? Why not some other day? Or why not do it as part of the main document?
Well, the review is quite detailed, and it goes into background on the process, legal framework, so its conclusions are reflected in the main document in terms of the revised forecasts we do. Because it included details of those forecasts and the rationale for why they've changed, they form part of our forecast judgments, and therefore they were market sensitive. So for that reason, we couldn't put it out before Budget Day.
Any further questions in the room? We'll come to this gentleman here and then the one at the back.
Paul Wallace, I'm a freelance journalist. You show in the OBR, in the report, that roughly 10 billion, on your slide, 10 billion of tax revenues are coming from various compliance, about 4 billion from that, about 6 billion from capital taxes. And you say elsewhere in the report that the capital taxes are highly uncertain. I mean, so how secure are those 10 billion of revenue?
We'll go to Tom on that one, please.
Yeah, thank you. So, as we say in the report, both the yield that we assume from the compliance measures and from the capital taxes is particularly uncertain for different reasons. On the capital taxes, we do assume quite a big behavioural response to the rate changes. So people deciding to either hold on to assets for longer, shift into different assets as a result of the changes. But those assumptions are very uncertain. They're based on evidence from previous times that policies have changed in similar ways, and evidence from studies that have been done on those kind of responses, both in the UK and globally, but certainly a lot of uncertainty around those. On compliance, it is a very big package of measures. A large part of it is essentially HMRC employing a lot more people, both to tackle tax compliance directly, but also to try and collect more outstanding debt. And it is the case that there is currently a lot more debt outstanding than there has been in the past. It built up during COVID and during the cost of living crisis. And again, we make a lot of assumptions around the fact that over time, that yield will become more difficult to collect as both, you sort of start to get to the more difficult compliance areas and outstanding debt, and also because people will change their behaviour in response to the action that HMRC is taking. So the sort of estimated yield is reduced quite significantly over time for those factors. But it is a big injection of additional staff into HMRC, so we do assume a fairly large yield from it, but it is certainly uncertain.
Sorry, just speak into the microphone so everybody can hear.
Just as a follow-up, it is a measure which previous chancellors always tend to include, and has been rather ropey in the past.
So just on that point, if I can, so when we're estimating the yield, we take into account of previous measures, and we look at the impact of the new ones on top of those to try and address that sort of risk that you're raising. I mean, it is also the case that if you look at the tax gap, which measures the difference between the sort of theoretical amount of tax out there that HMRC can collect and the amount they do actually collect, HMRC have been quite successful over the past 20 years or so in bringing that gap down, which we think is a large part due to previous compliance activity. It's also probably due to changes in the economy, in particular, less use of cash means it's much more difficult to be non-compliant on VAT. So there is evidence, that it is possible to reduce the tax gap.
Thank you. We'll go to this gentleman here now, please.
Thanks. Jack Barnett from The Times. You've quite substantially raised your inflation forecast across the 5 years. I just wonder whether or not, could you give us a broad stroke assessment as whether or not this budget is going to be marginally inflationary? And then just a second, if I may, we've seen another change to the fiscal rules. I don't know how many we're on now, but I just wonder whether or not there is an assessment as to this new set of rules. Are they good? Are they bad?
I'm going to ask David to come in on inflation, and then Richard, you can have a go at rules.
Yeah, the inflation profile is a bit higher than it would have been if there hadn't been quite a substantial increase in spending. And the reason for that is that although we think there's a little bit of spare capacity in the economy right now, the scale of the increase in spending is substantial. And it probably pushes the economy, at least for the next couple of years, a little bit into the territory of demand running a bit ahead of supply capacity of the economy. That causes inflation to be a bit higher for a couple of years. We then assume that the Bank of England responds to that, so that 3 or 4 years down the road, we're really back to close to the government's target, or the Bank of England's target that is given by the government, back to the 2% level. So you get a sort of slightly higher rate of inflation. I think we get up to 2.6 or so % for the next year or so. So it's meaningful. Of course, in the context of an economy which not all that long ago had an inflation rate of 11%, to go from the target level of 2 to 2.6, it needs to be seen in the context of how variable inflation can be. But I think it's a reflection of two things. Firstly, just the size of the increase in spending, only about half of which is covered by taxes. So in a sense, it's a fiscal loosening, because it's not all covered by taxes, in an economy where there really isn't a whole lot of spare capacity right now.
Thank you. And are these rules good?
So we tend to not answer that question, partly because chancellors are very good at selling their own fiscal frameworks, and so we tend to do features and risks at the OBR. And I guess I'd say there are maybe two of the more notable changes to this set of rules, and as you say, we've had a lot, which says something about how binding any one set are. The big innovation is public sector net financial liabilities, in which the Chancellor is kind of explicitly targeting the financial balance sheet, not just one side of it on the debt side, and then with a little bit of liquid financial assets. This allows the Chancellor to basically borrow to invest in financial assets only. And so I guess one of the features of that is that so long as the borrowing is going into is being put into some kind of financial instrument, which is in government's cases usually a loan or the purchase of equity, that is neutral for the measure. That allows the Chancellor to make greater use of leverage in things like the National Wealth Fund, which otherwise a pure debt measure would limit. The risk there is that governments start to exploit that and treat it as a loophole, and the government starts to do lots of things which might deliver better value for money through straight investment in physical assets. They start doing it all through financial instruments. They start doing it all through loans or all through equity in companies or funds. And the danger with those is that those things get valued in a certain way, and those valuations turn out to be wrong. One of the things which we will be doing in the OBR, with the help of our colleagues in the National Audit Office, is making sure that those valuations are robust, where we think that some of those loans that are being made aren't likely to be repaid. That likelihood of non-repayment is reflected in the valuation of those loans and in our forecast for the performance of those loans. So it's going to be more work for us to look at the asset side of the balance sheet, but given that that target has been chosen, we will have to do that. So I'd say that's a risk around that particular rule. I think another important feature of this set of rules is that we've had quite a long period where rules apply to the 5th year of the forecast, and it tends to be the further out you go, the more uncertain our economic forecast is, but also the more uncertainty there is about actually what government policy is. One of the advantages of bringing forward the deadline for the rule is it brings the deadline for the rule more likely into overlapping with the deadline for government spending plans. We've been in a situation in the UK for a number of years now where 4 out of the 5 years of our forecast is not covered by detailed plans for spending. Now, that's still true today, right? Because the government's only done a 1-year spending review. But there is a commitment now to go back to doing a regular rhythm of spending reviews, which would fill out more of the distance between here and the deadline with detailed spending plans in ways which we haven't had in a while in the UK, and hopefully maintain kind of that level of transparency about what the fiscal rule implies for the government's detailed plans for departmental spending between now and the deadline.
Thank you. I'm going to take some questions from Slido now because there are loads. If you're in the room and you want to ask another question, just kind of wave at me and I will come to you. David, I'm probably going to come to you on these. Another popular set of kind of theme of questioning around working people. So Sue Chan asks, do these budget tax rises hit working people? And will extra public, oh, she's gone for a bonus, 2 questions. And will extra public spending hit interest rates and mortgage rates for longer? John Paul Ford Rojas asks, regarding the 50,000 average hours equivalent reduction in labour supply due to the national insurance policy, what does that mean? Does it translate into a higher unemployment rate? And can you quantify impacts on wage growth? And there's other questions asking about Labour's commitment not to tax working people and what your view is of that. Yeah. So a set of questions around working people.
Yes, well, I mean, a lot of those questions in a sense are about the national insurance measure, the increase in the employer rate. And of course, the incidence of that tax is companies in the sense that they actually pay the money, but whether or not that's the ultimate place where the tax comes to land is a different question. And it seems highly likely that it will have an impact on the level of wages that firms who are facing higher taxes on employing people will pay. So our assessment is based on the sensitivity of demand for labour from companies and on the supply of labour by individuals, that a significant proportion, certainly over the longer term, of the impact of the higher tax will feed through into wages being lower than they otherwise would be. So something like, in the longer run, 3/4 or so, 75% or so, of the impact of the higher tax will end up being felt in a lower level of real wages than they otherwise would have been. So that's the difference really between the sort of formal legal incidence, who pays the bill, and where does it actually end up in economic terms. And the answer seems highly likely that most of it will feed through into the level of real wages. So what was the other part of the question?
Yeah, so there was John Paul Ford Rojas asked specifically about the reduction in average hours equivalent employment and the 50,000. Unemployment.
Yeah, the 50,000. Well, the translation into unemployment is next to nothing, because the way to calculate what the impact will be is to work out what combination of some people deciding they're going to work less because real wages are a bit lower than they otherwise would have been, and how much lower is the demand for labour, because not all the impact of the tax can be passed on by the company to the worker. So we kind of work out, you can think of the 50,000 number as how much lower will the size of the labour force in the UK be, because some people just at the margin find that the lower real wages they're going to get as a result of the tax increase mean, well, actually, I don't want to work so much. So it doesn't actually flow through to unemployment at all. It does flow through to a slightly lower level of the labour force and a lower level of employment than it otherwise would have been. But that's a 50,000 number, that's our central estimate, in a labour force of 32 million or 33 million people in the labour force. So, 50,000 as a percentage of the labour force is not enormous, but at the same time it's not a totally insignificant number. Unemployment, by the way, over our forecast period, remains pretty low, certainly in the short run, because we've got a very substantial boost to demand from the fiscal loosening over the next couple of years, and that actually takes the economy into a position where output is pushing up against and going slightly beyond actually the productive potential of the economy. So unemployment actually stays low on our central projection.
And then the final, Sue's second question, we've had other questions on the same theme. Sue Chan also asked, will extra public spending keep interest rates and mortgage rates higher for longer? Mark Willis also asks, is a material impact in gilt markets expected in response to the additional debt by 2028-29? So a couple of questions on gilts and mortgages.
Well, the pressure, if it exists, of higher government spending depends very much on how it is financed. I mean, to the extent that it's financed out of taxes, in a sense, the government is taking away demand from the private sector, which pay the taxes, to make room for its extra use of resources. Now, in this budget, there's a big increase in spending, which is significantly, but certainly not wholly, financed through taxation. In fact, taxation finances about slightly more than half of the 70 billion or so extra government spending a year that you get over the next few years. And the other half is financed by more borrowing. Of course, the more borrowing bit means that the government's spending money, which by definition it hasn't raised through taxes, and so it's not reducing demand in the economy in line with its own bigger claim on resources. That's what pushes the economy to a situation that we think is a bit above its potential. And it's plausible that there is a reaction to that, both from the Bank of England, which you might expect, partly on the back of slightly higher inflation, to set a slightly higher path for bank rate than it otherwise would, and also because the government is borrowing rather a lot more than people might have expected in the past. If the previous government's plans had played out, they were planning to borrow less. You have to induce people to buy the extra gilts that are coming onto the market. We think the net effect of both those things might be to add something of the order of 0.25% to interest rates, to yields on government bonds, maybe to the path of bank rate. That's what we've factored in relative to when we looked at market expectations. We just added 25 basis points, 0.25% on that to take account of this effect. So is it likely to have an effect? We thought yes. What is the scale of that effect? 25 basis points is, neither completely trivial nor, a game changer in terms of the projection for the economy. What the reaction in the gilt market will be is a bit hard to know. I mean, today gilt yields first of all went down and now they've gone up a bit. Who knows where they'll be by the end of the day? There's still a couple of hours to go. And who knows where they'll be by the weekend. But our assessment was that interest rates would be about 0.25% higher than they otherwise would have been.
There speaks a forecaster, David.
Anything could happen. Yeah, exactly.
Thank you for that.
Safe.
A couple of questions. Sorry, I'll come to you in the room. Just wait for the microphone.
Thank you. I was just wondering, it sounded like you were saying that working people, so people who mostly get their income from employment rather than assets, will be impacted by the tax rises in this budget. Is it possible to put a figure on how many working people are likely to be affected?
Well, I think, there's quite a broad range of tax increases. And, when you've got the government making space, if you will, for substantial increases in its own spending, it's very likely that the majority of people will face some more taxes somewhere. The one that I focused on a moment ago was just the national insurance one, where, as I said, the lion's share, about 3/4, we think, of the impact of that will ultimately come through in the form of lower wages. And that's likely to affect the majority of people who are working.
Could you put that in millions of workers by any chance, a rough estimate?
Well, the level of employment in the UK is 33, 34 million, something like that. We haven't done a sort of distributional calculation to work out what percentage of people might not have any effect at all. And there will be some who won't. So, for example, somebody who is earning national minimum wage, companies can't legally can't pass on the incidence of the extra tax there. So there will certainly be people, and there's 2 million odd people, I think, in the UK who are on the national minimum wage. They're not going to see their wages lower because it's not a legal thing to do. So there's definitely, just on the national insurance thing, although I think the majority of people will find over time that their real wages are a bit lower than they otherwise would be, there's certainly some people who won't.
20, 25 million?
I think it's hard to put a precise number on it. I think it would be fair to say that I think the majority of people will find their real wages would be a bit lower than they otherwise would be. But that will take time. I mean, in the short run, I mean, I think the way to envisage it probably happening is not so much companies tomorrow issuing an edict for their workforce saying, hold on, our employment costs have gone up by 2%, everybody's going to take a 2% wage cut right now. That's not going to happen. I think what will happen is gradually over time, maybe next year and the year after, a company that might have given a 3% wage increase will make it 2.5%. And, you know, a few years of that and a substantial part of the burden of the higher national insurance will have been passed on to the workforce.
Cool, thank you. We're going to go to a couple of questions on different taxes. I'm going to come to you, Tom, both from Kieran McCarthy. One is the Chancellor said raising VAT on private schools was expected to raise 1.9 billion. The OBR estimates 1.7 billion. Are you able to explain the differences in estimates? So, if you're not familiar with that Chancellor figure, perhaps you could just explain ours. And also asks, is there a financial argument in favour of keeping the freeze on fuel duty rates, given the 3 billion or so cost of doing so? So a question on VAT on private schools and a question on fuel duty.
Okay, thanks. So on VAT on private schools, our estimate in the final year of the revenue raised is 1.7 billion, which I think is the same estimate as is the same estimate as the Treasury have in their Red Book. I mean, the biggest judgment there, obviously, is on the degree to which parents take their children out of private school or don't send their children to private school as a result of the increase in VAT, which we assume a large part of would be passed on as higher fees. Our assumption is that there are around 35,000 fewer pupils in private schools as a result of the measure after 5 years. But that is, again, it's an uncertain judgment. On fuel duty, well, I mean, from a fiscal perspective, there is a very significant cost from the repeated practice of previous governments and now this government of not implementing the stated increases in fuel duty. I think we've estimated that if you go back to 2010, which I think is the last time it was actually implemented around then, the total cost of public finances has been around 100 billion from not implementing those increases. And looking forwards, our forecast does assume that from next year, the policy will be implemented, fuel duty will increase, reverse the 5p cut. And therefore, that benefits the public finances in our forecast by around 5 billion in the final year of the forecast. The margin that the Chancellor has left against her current balance rule is around 10 billion. So not implementing those measures again would immediately cut out around half of the headroom that the Chancellor has against her fiscal mandate.
Thanks, Tom. Couple of questions probably coming back to you again, David, on these, on I guess kind of on the theme of business investment and crowding out. So Philip Inman at The Guardian asks, why does business investment fall over the 5-year forecast, and why does higher national insurance payments by employers play a part in this? Ben Bidwell asks, please can you explain a little more on what is meant by crowding out on the supply side changes over the forecast period?
Okay. Well, the government, I mean, pretty much in this budget takes about, I mean, public spending is about 70 billion higher a year. And that's a big number, but 2% of GDP or so. So about half of that, a bit more than half of it, is funded through extra taxes. So that naturally that tends to reduce private sector demand upon GDP by however much extra tax they pay. Most people spend most of the money they earn after tax. But only half it's funded that way. The other half is borrowing. in an economy such as ours where there isn't much spare capacity, if the government wants 2% more resources but only takes 1% away from the private sector through taxes, you've got to make room for the other 1%. And that's what we mean by crowding out. So interest rates are a little bit higher, as we mentioned a short while ago. Inflation is a little bit higher. Both of those things would tend to depress private sector demand. Interest rates feed through to people's mortgages and other debt. It increases a bit the cost of borrowing for companies to finance investment. Inflation being a little bit higher in a world in which companies are facing higher national insurance contributions mean that real wages will be a little bit lower than they otherwise would have been. That squeezes out a bit more consumption. Some of the effects of this necessary making room for a bigger state affects business investment. So that's a bit lower than it otherwise would have been. Turns out on our forecast, when we kind of run the numbers, that the total amount of investment in the economy, if you add together extra government investment and a bit of squeezing out of business investment, the sum of the two, which is like total investment in the economy, is actually a little bit higher. But it's not a whole lot higher. And what that means is that the sort of productive potential of the economy, because you've got a positive effect from more government investment and a bit of a negative effect from somewhat less business investment than there would have been, leaves productive potential about where it would have been. And that's why the growth in GDP over the forecast horizon is not a whole lot different, because it has to ultimately grow in line with productive potential, than it would have been before the government introduced a kind of big package of measures. So that's, I hope that helps understand what we mean by crowding out, which is a nasty bit of economics jargon, I'm afraid.
Thank you, David. Tom, I'm coming back to you with a couple of questions on taxes again. Ashley Lane asks, what has your forecast assumed about innovators, businesses and individuals leaving the country or economy and going overseas? And there's an additional question on the same topic, which says increases of CGT, taxes on air passenger duty, ending the non-TOM tax status, VAT, etc. How did you model impact on growth and the potential loss of high net worth individuals leaving the country?
Thanks. So there were two measures in particular where this was a particularly relevant judgment because they affect high net worth individuals and individuals with less ties to the UK, may well be from overseas. That's the increase to carried interest rates and also the further reforms on the non-domicile regime. In both cases, we're talking about very small groups of people. In the case of the non-domicile reforms, it's around 9,000 people who are not eligible for the new regime and therefore potentially at risk of leaving the country as a result. For the carried interest, it's only around 3,000 people who benefit from carried interest. In the case of the non-domicile regime, we had an assumption under the previous government's first set of reforms that around 10 to 20% of that ineligible population would leave the UK as a result of the measure. We've increased that slightly at this event for the new reforms. That reflects some changes that the new government has made to the transitional protections which are offered to those people who are ineligible for the new regime. And it also reflects the fact that inheritance tax has been brought into the new regime. But it's actually quite a small increase in our assumption. The main 10 to 20% has only been increased by a small amount. On carried interest, the assumption is that there is around 12% of that 3,000 people who are particularly at risk of leaving the UK as a result of the measure because they are overseas citizens, have spent less time in the UK, are particularly high net worth. And roughly we assume on the basis of the measure that we lose tax yield from about a quarter of that population as a result of the measure. Again, sorry I keep saying this, but these are obviously very uncertain assumptions and judgments as well, because they're based on decisions by basically a very small number of people. We haven't assumed that that has an impact on our economy forecast, which I think was part of the question, essentially because this is a very small number of people that we're talking about.
Thank you very much. David, I'll come to you on this. Delphine Strauss at the FT asks, what is the impact of the budget on living standards and which measures drive that?
Well, I mean, there's a kind of broad measure of living standards which includes, you know, the private consumption people enjoy plus their consumption of public services. And public services are going to have a lot more money spent on them. And because the tax take out of GDP is going up, that's partly funded by lower post-tax incomes to people who will find their private spending probably curbed a bit. So what's the net impact on standards of living? That's a difficult judgment. It depends how much people value private consumption versus public services. There's a kind of narrow answer to the question, which is to look at real household disposable income, the after-tax real income per household. And as a result of the budget measures, that's about slightly more than 1% lower than it otherwise would have been. I mean, it's still on our forecast, it still goes up over the next 5 years, but at the end of 5 years, it's about 1%, maybe a bit more than 1%, 1.25% lower than it otherwise would have been. Now, that's almost inevitable, given that the government's taking 2% more of GDP to spend on public services and public investment. So the narrow way of measuring it would just be to say what happens to real household disposable income, their ability to spend money on private consumption. That's about 1% of GDP, 1% lower than it otherwise would have been. But then again, public investment and public services are going to have a lot more resources devoted to them.
Thank you. Richard, I'm going to come to you. A few questions on PSNUFL, new fiscal rule. Philip Shaw asks, will any government investment in the National Wealth Fund be netted off from liabilities in PSNUFL? Luke asks, does the OBR find it prudent for the government to have changed the definition of borrowing so that they are able to borrow more to invest? So maybe that relates to the mix of rules, not just PSNUFL. And another question on how do you identify the value of public assets in measuring public sector net financial liabilities when they seem quite difficult to quantify? So a few questions there about the coverage of PSNUFL and its function as a fiscal rule.
Yes, well, I think one answer to both questions is check out the annex of the EFO, we have a whole annex on PSNUFL which tells you what it's comprised of, how it performs, how it differs from other fiscal measures, what the risks around it are. So if you don't get what you want to know from me, you'll definitely get it from in there. The short answer on the National Wealth Fund is yes. Investments done by the National Wealth Fund and funded by borrowing do net out in PSNUFL so long as they are investing in financial instruments. So long as they're issuing loans or they are delivering equity injections into infrastructure companies, which then do the investment, then that does count as a financial asset and it nets off within PSNUFL. What they can't do but keep PSNUFL unchanged is invest directly in things like energy investments. So they can't buy the windmill, they have to invest in the company or make a loan to the company that builds the windmill. And I think therein one spot's potentially one of the risks, which is that the investment has to be indirect through some kind of private sector vehicle or through the extension of some kind of financial instrument, and then the money is then used by the person who receives the investment to do the actual physical investment. So that creates risks, obviously, and it's one which the government has set up some guardrails to try and monitor, but we ourselves, as independent forecasters, are also going to keep an eye on. In terms of asset valuation, sort of details are set out in the annex about how different kinds of assets are valued. Some of these things are very easy to value, because if the government just buys equities that are listed on the stock market, then you've got a market valuation for them. For other things like loans, you have to value the loan book, based on expected repayments over time, and so it does depend on the asset. We follow national account standards when doing valuations, and for things like loans where we expect there to be some probability of non-repayment, we take that into account in the valuation of the loans, but that's obviously something you also have to keep an eye on, because loan valuations can change over time. In terms of whether the overall framework is prudent, part of our job is to make sure that it's transparent. Whether it's prudent depends on the decisions taken by the government in where they invest their money, and whether they do actually get the financial returns that they are hoping for. I think from our point of view, we will make sure that we're doing scrutiny and due diligence on the valuation of those assets, but the value of those assets will depend on the choices that government makes in how it invests. A final thing to point out is that just within the overall monitoring of the public finances, one does have to also keep an eye on the level of debt, because the level of debt is the one in which the government always has to pay, regardless of whether it's getting repaid by somebody else when it loans out the money. At least on one measure of debt, it's rising in every year, the measure excluding the Bank of England. And this is, I think, the first forecast we've done in a very long time, and possibly ever, where the cost of servicing the government's debt was over £100 billion every year. And that is, that is the cost of the amount of debt that we have run up. And that cost doesn't just go away because you're targeting a different fiscal measure. That's still a cost that you have to meet every year. And it's one of the reasons why the tax burden in this country has been rising so much in recent years. It's to fund the fact that debt interest is just a lot more expensive, and our debt stock is a lot higher.
Thank you. I'm going to apologise in advance. There's absolutely hundreds of questions online, and we're not going to get to them all. We'll follow up if you contact us on as many as we can. We're going to try and squeeze in two more. Penultimate one for you, David. Do the OBR's forecasts account for potential growth in the medium term due to general population health and productivity as a result of public spending? And a similar question from Sarjan Narwan, who says, what expectation do you have on the impact of increased NHS spending on growth? So two kind of very similar questions there, and you can be nice and snappy so we can fit
I'll be snappy. I think it's difficult to try and pin down. Well, there's two legs in the calculation, aren't there? You spend more money on the NHS. To what extent does that improve the health of the population of working age? And as a result of that, how many people, because they feel healthier and they're of working age, decide they're going to carry on working longer or work longer hours? And I think over the 5-year, over the relatively short term, which is a 5-year, it's difficult to think that number is either easy to calculate or is likely to be extremely large. I mean, it may be that much of the improvement, if there is a significant improvement in the National Health Service, is focused on people who are really very unwell, and it makes a transformative difference to the quality of their life, but it's not going to have much effect on how much they want to work or when they're going to retire. But nonetheless, it is of extraordinary value in terms of welfare and utility. So we haven't factored that in. I think if effects do come through and they have effect on the labour force, it's likely to be over a slightly longer horizon.
And I'd point people towards our Fiscal Risks and Sustainability report published last month, which had a whole chapter on the fiscal effects of better population health over the longer term. Okay, last question. There's been a lot of follow-up on black holes, so we're going to have to end there. Richard, I'm coming to you. Sue Chan asks, sorry, a follow-up. Does this mean you think the black hole is actually 9.5 billion, brackets precious minus pay rises? Another person asks, so the 22 billion black hole is actually 9.5 billion plus extrapolation by the government. That is not confirmed by the OBR. And a series of similar questions on the difference between those two numbers. I mean,
the short answer is that I'm an economist, not an astronomer, and we don't deal in black holes in the OBR. What we do is try and forecast government spending. And when we were putting that forecast together back in March, the Treasury had information about £9.5 billion worth of pressures on public spending that we were not aware of. What we can't say is that had we known that information, what different number would we have put in our EFO back in March? We know it would have been materially higher, but we would have also had a conversation with the Treasury about what they would have done about those pressures. and take into account what they then told us. Because they didn't disclose that information, there's no way of knowing how much, how different our forecast public spending would have been back in March. It would have been materially higher, and that's all we can say.
Thank you, Richard. So that, as I said, I'm afraid that is all we've got time for this afternoon. There were an awful lot of questions that we didn't get to. Please do get in touch with us and we will follow up with you and provide answers to those if we didn't manage to answer your question in this press conference. I'll just wrap up by saying thank you everyone for joining us today. We very much look forward to seeing you at our next event in the spring.